Reading time for the final exam, use your 10 minutes to the best of your ability. They won't let you write. Since you can't write, read the questions and work out what you can answer first that will be quick, easy marks for you to get in the exam. Because usually with exam questions, there are some questions that you've studied quite well and you can answer certain questions pretty quickly and easily. And there might be other questions that you found a bit harder or you didn't study as well that are going to take more time. Use your 10 minutes of reading time to plan your 2-hour exam time. One of the biggest issues that students have with exams is they don't manage their time and they don't finish the exam because they didn't manage their time. The other thing to do is to allocate how many minutes you're going to spend on each question and try to stick to that allocation fairly strictly. If you can allocate your time based on the marks that each part of the exam is worth, then once the time is up, move on to the next part or the next question. And if you have extra time at the end because you finished everything more quickly, go back and have a look at the parts that you left. Time management is really important. And an easy way of managing your time is allocating time to each question or section based on the amount of marks that it is worth in the total marks for the exam. So if you've got multiple choice questions in the exam, which you do, how many multiple choice questions are in your exam? 10. How many marks are they worth? How many marks are there in the total exam? 50, yeah. So if the multiple choice are worth 10 out of the 50 marks in the exam, that's 20% of your exam marks, and you have 2 hours or 120 minutes. How much time should you spend on the multiple choice? 24 minutes should be more than you need to answer those 10 multiple choice. They're not that complex. I don't think there are calculations necessarily. If there are, there's nothing difficult in the multiple choice. 24 minutes for those 10 marks should be more time than what you need to answer those questions. So if you finish the 10 multiple choice and you haven't used all 24 minutes, you've now got some extra time that you can use to spend on other questions. If you're doing one of the other questions, let's say you're doing question 1, and question 1 is worth 8 marks. How much time should you spend? $19 minutes? 19 minutes for an 8-mark question. That's almost 20 minutes. That's quite a lot of time to spend on one question. This is what you need to be thinking about, and think about it before you go into the exam. Don't waste your reading time trying to work this out. Think about it before you go in, because I put the exam structure up on Canvas. Think about your 2 hours, your 120 minutes. You need to maximize the marks that you can get as quickly as possible in that 2 hours. So time management's really, really important. Make sure that you have access to the time. Do the exam rooms have a clock? Yep. So make sure that you keep an eye on the time. They won't let you take your phone in and sit your phone on the desk and use it as a timer. So you're going to have to keep an eye on the clock. And you might even write on your exam paper at what time you started writing and at what time you should move on to the next question. I don't mind if you write the times on the paper. That's not an issue. Time management will be really, really important. Unfortunately, it costs a lot of students a lot of marks because they don't manage their 2 hours, and 2 hours will go really quickly once it starts. Are there any questions that you guys have in relation to allocating your time or what to use your reading time for? Is everyone pretty comfortable with that? So what we're going to do, if we have time, I'll come back to those practice multiple choice, but I actually wanted to move to the other questions. So the first question here, which is more of a calculation question, and I've added in this solution, which I'll put up on Canvas after class, I've added in here which weekly topic the question is drawn from. So this question is from the week 8 course materials. And what I thought we could do, if we're going to look at a week 8 question, is go to the course review and skip ahead to week 8. Oh, that was week 9. Week 8. Do you guys remember week 8? We can skip over some of this information. In week 8, we talked about things like how we measure risk and return in finance. We talked about how return can be measured as a total dollar return, or it can be expressed as a rate of return as a percentage. And I remember saying to you in that topic that we more often would express returns as a percentage, as a rate of return. We talked about things like the risk-free rate. In Australia, I remember saying that our Commonwealth government bonds are considered to be very safe investments. The Commonwealth government's very unlikely to default if you lend the money. So we use the yield or the rate of return on a Commonwealth government 10-year bond as an example of a risk-free rate. And the risk premium was the extra return that you get from a risky asset above the risk-free rate. It's that reward that you get for bearing risk when you invest. We talked about how we can measure risk, and we looked at calculating variance and standard deviation. Variance is a way of looking at volatility or risk in the returns for an asset or a portfolio of assets. And there's a formula on the formula sheet that you can use to calculate variance, but the formula really won't mean anything to you if you haven't practiced the calculations. So the variance is the sum of the difference between the actual return and the average return squared all over t minus 1. So t minus 1, t is the number of observations or the number of pieces of data that you have, minus 1. We also looked at standard deviation. Standard deviation is how we measure total risk in finance, and standard deviation is the square root of the variance. We normally express it as a percentage. The higher the percentage, the higher the risk of the asset or the portfolio of assets. We talked about the difference between an arithmetic average and a geometric average. The average return that we calculated in class in that topic, we calculated the arithmetic average, where you just add all of the returns up and divide by the number of returns that you're adding together, the arithmetic average. In that topic, we also looked at at the future. Initially, we looked at using historical data, using data from the past and calculating average returns on historical data and calculating variance and standard deviation using historical data for an asset. But then on and we started looking at expected returns. We looked at the expected return, which is forward-looking, looking at the future. And to calculate an expected return, we need the probabilities of possible outcomes in the future. The expected return is the sum of the probability of that state happening multiplied by the expected return in that state. Remember, when we were looking at that, we were looking at states for the economy, things like recession, boom, normal, bust, things like that, different states of the economy. So the probability of the economy being in that state and what return we would get if the economy was in that state. We also looked at calculating variance and standard deviation using expected returns from an asset. So we did that using historical returns, and we also looked at doing that using expected returns. And the variance, if we're using expected returns, the variance is the sum of the probability of that state happening multiplied by the return in that state less the overall expected return. And we square that. So it's really important that for a single asset, you can calculate for a single asset, you can calculate average returns, you can calculate expected returns, you can calculate variance and standard deviation. You need to be able to do that for a single asset. And for a portfolio, what's a portfolio? A collection of assets, a group of assets, or a collection of assets that you've invested in, a portfolio. For a portfolio, you will need to be able to calculate the expected return from that portfolio. So this is an important topic. Measuring risk and return for a single asset and being able to calculate the expected return from a portfolio, from a collection of assets. So for a portfolio, this is an important calculation. We've already said a portfolio is a collection of assets. The expected return from a portfolio is the weighted average of all the expected returns from the assets in the portfolio, which is this formula at the bottom. The expected return from the portfolio is equal to the sum of the weight that each asset makes up in the portfolio multiplied by the expected return from the asset. So you need to be able to do that calculation for a portfolio, calculate the expected return. We talked about those two types of risk, systematic and unsystematic risk. Systematic risk I refer to as market-wide risk factors. So the risk factors that will affect lots of companies. So things like changes in GDP, changes in inflation, interest rates, exchange rates. They're factors that will affect a lot of companies, market-wide factors. How do we measure systematic risk? What's the measure called? Beta. We measure systematic risk using beta. And we didn't look at calculating beta, thank goodness. You don't have to calculate beta, but you need to know what beta is. It's a measure of systematic risk for an asset. The higher the beta, the higher the systematic risk of the asset. If risk is higher, the higher the return we would expect to get as compensation for investing in the asset. The other type of risk is unsystematic risk. Unsystematic risk I refer to as the company-specific risk. And it's this risk that you can diversify away from. What does it mean to diversify? Investing in different assets. If you're buying shares in companies, choosing companies in different industries, different companies, investing in different assets. And by diversifying, by investing in different assets, you can significantly reduce the total risk. There might also be a reduction in return, but it's not as big as the reduction in risk. So you can definitely benefit from diversifying, from investing in different assets. So we've talked about diversification. We've talked about measuring systematic risk. We use beta to measure systematic risk. It's a relative measure. It's relative to the market overall. So beta is exactly 1 for an asset. It has the same systematic risk as the market. If it's less than 1, it's got less systematic risk, and greater than 1, it's got more. It's a relative measure. This was another important concept that we covered in that topic, the capital asset pricing model, which is also sometimes referred to as the security market line, the SML, the security market line, the capital asset pricing model. This one is a good way of estimating the expected return from an asset because it takes the systematic risk of the asset into consideration. If we need to estimate the expected return from shares, from ordinary shares in the company, if we have the risk-free rate and we've got the expected return on the market portfolio and the company's beta, we can calculate the expected return for the ordinary shareholders in the company. So that was an important equation that we then came back to use when we were looking at measuring the weighted average cost of capital. So if we go back to the question, we've got some information that relates to shares in a company, just one company, not a portfolio, just one company. There are 3 possible states of the economy in the future. There's a 30% probability that the economy will be booming. If the economy is booming, we would expect to get a return of 40% from shares in that company. There's a 50% probability that the economy will just be normal. If the economy is in a normal state, we would expect to get a return of 15% from shares in that company. And there's a 20% chance that the economy will be in recession. If the economy is in recession, we would expect to get a return of minus 12% from shares in that company. We need to calculate the expected return from investing in shares in that company, the expected return. Expected return means that we need to take the probability into consideration. The expected return. So the expected return is the sum of the probability of the state occurring multiplied by the return in that state. There are 3 possible states for the economy. So we're going to have 3 calculations and add them all together to get the expected return from the asset. So we're going to use that formula. So for part A, the expected return is equal to the 30% probability that the economy will be in boom. There's a 30% probability the economy will be in boom, multiplied by the return in that state. The return in boom is 40%. So 30% probability multiplied by 40% return in that state. Plus, there's a 50% probability the economy will be normal, multiplied by the return in that state of 15%. Plus, there's a 20% probability the economy will be in recession, multiplied by that return of minus 12%. So the expected return from investing in shares in that company is 17.1%. We also need to calculate the variance. So to calculate the variance is the sum of the probability of that state occurring multiplied by the return in that state minus the overall expected return. We've calculated that here, 17. This ER is the 17.1% that we calculated here. And we square them and we add them all together. So the variance is the probability of the economy being in that state. There's a 30% probability of that state multiplied by the return in that state. The return in that state's 40% minus the expected return of 17.1% to the power of 2 squared. Plus, there's a 50% probability the economy will be in a normal state. In a normal state, the return would be 15% minus the expected return of 17.1% to the power of 2. Plus, there's a 20% probability that the economy will be in recession. If the economy is in recession, the return in that state's minus 10% minus the expected return of 17.1 squared. So I get a total of 0.030641. This is my variance. So I've used that formula, the sum of the probability multiplied by the return in the state less the expected return squared. Yep. This one? Oh, is it 12, not 10? Okay. Does that change the calculation or did I update it? Does it stay the same? I don't know if I updated that one. Doesn't have to update that. Is that what you get? Plus 0.002205 plus, hang on a second, minus 0.171 to the power of 2 times 0.2. Yeah. 2205 plus 0.0157323. Not 0.32. Yeah. Yep. That changes the next one. 0.32889, square root of that. Point 0.018135 or 18.4%. Are there any questions about using the formula and doing the calculation? So we've got our expected return. We need that expected return. Without the expected return, we can't calculate the variance. So we start by working out the expected return. When we've got the expected return, we use that in the calculations to find the variance. And then the last calculation is the standard deviation, which is the square root of the variance. So the standard deviation as a percentage, 18.14%. So I've just said to the power of a half, which is the same as using the square root button on the calculator. So you should be able to do those calculations for a single asset. You should be able to calculate the expected return from an asset. You should be able to calculate the variance from an asset using your expected return, and from the variance, calculate the standard deviation. What does standard deviation measure? Total risk from an asset, the total risk. So it measures the systematic plus the unsystematic risk. It measures the total risk from an asset. So let's have a look at the next one. I can see here the next one is from week 11. And in this one, it says calculate the economic order quantity. Let's just have a quick look at that in the PowerPoints. I've got the PowerPoints open. So week 11, we were looking at 2 chapters. We were looking at short-term financial planning, and we were looking at managing working capital. And specifically, we looked at managing receivables, managing inventory, and managing cash as part of working capital management. We talked about these different measures of working capital management. We looked at this diagram. We talked about the cash cycle. The cash cycle measures the number of days between when we pay our suppliers cash to when we get the cash from our customers, the number of days. The operating cycle is the longer measure. It measures the time from when we purchase the inventory all the way through to when we collect the cash from the customer. And we talked about how a good financial manager will want to shorten both of those. A shorter cash cycle is better, a shorter operating cycle is better. So for a financial manager, when you're looking at liquidity, they're 2 really important measures, your cash cycle and your operating cycle. And we talked about these policies that can be used in short-term financial planning. We talked about using a conservative or a really safe policy. The conservative policy is the policy that results in high liquidity. It's the policy where you have lots of cash, lots of inventory, and you have lots of accounts receivable because you sell on credit very easily. And the aggressive policy or the restrictive policy you have very low cash, you don't hold much inventory, and you have a low accounts receivable balance. You actually prefer not to sell on credit. So if you use the restrictive or aggressive policy, you're operating on really low levels of liquidity. In practice, what do financial managers normally use? Yep.
Can you get these questions in exam, like explanation questions? Like
yep.
Theory questions?
Yep. Yeah. Do financial managers normally use conservative or aggressive policies? What do you think happens in practice?
Combination.
Yes, perfect. Something in between, because they're extremes. They're at opposite ends of the spectrum. One's really, really, really safe. One's really, really, really aggressive. And it wouldn't be sensible to use either extreme. So in practice, we're somewhere in the middle, combination of those two policies. So we talked about reasons for holding cash. The speculative motive for holding cash, keeping a bit of extra cash in case an investment comes up and you want to invest and try to make profit. The precautionary motive, which I think is quite normal. It's quite normal human behavior to try and keep a little bit of extra cash in the bank account in case of an emergency. And the transaction motive, which we would all have to keep cash for our normal day-to-day cash transactions, we need to keep some money in our bank account. So I think of all of those, even individuals would hold cash for precautionary and transaction motives. But the other one, maybe not. So we talked about receivables, we talked about managing inventory, and we talked about this economic order quantity model as one of the methods that a financial manager can use to try and minimize the total cost related to inventory. The problem with inventory is that there are these two general costs. There's the carrying cost of inventory. If you hold lots and lots of inventory, you would have lots of carrying costs. Things like storage, insurance, your carrying costs would be high if you hold lots of inventory. And the other cost is the shortage costs. If you don't hold inventory, you could run out of inventory. You could lose sales. That's a big shortage cost, losing sales to customers. And the other cost that you incur if you run out of inventory is the reordering cost. When you order from your suppliers, if you're ordering small amounts of inventory very frequently, they're going to charge you fees for your orders. So the more you're ordering, the more ordering fees you pay to your suppliers. So managers need to try and find the right balance. They don't want to have big carrying costs. They don't want to have big shortage costs. They don't want to hold too much inventory. They don't want to run out. What's the right balance? The economic order quantity model is a model that is designed to help us calculate how much inventory we should order from our suppliers to minimize the total costs of having inventory. So it helps us to minimize the carrying costs and the shortage costs. The optimal order quantity. And the formula, which is on the formula sheet, the optimal order quantity is the square root of 2 times the annual demand or the annual sales, which is T, times F. F is that ordering cost, that fixed cost per order that your suppliers charge you, divided by the carrying cost per unit of inventory. And for retailers that are managing inventory, they would definitely have access to this information. Retailers that are managing inventory usually have pretty sophisticated inventory systems, they're computerized, and they can access all kinds of data about their inventory. So it wouldn't be too difficult to calculate their economic order quantity using data that they can access from their system. We also talked about just in time. That was one of the last ones that we looked at. But let's go back to that question. That question was calculating the economic order quantity for this particular item of inventory. So the carrying cost is $1.85 per unit. The fixed order cost is $23. And they sell about 1,400 units of inventory in a year. To minimize the total cost, the carrying costs and the shortage costs in relation to this product, we need to calculate the economic order quantity. What's the optimal number of units they should buy from their supplier each time they order to minimize the total cost in relation to their inventory? So using the formula from the formula sheet, we've got T is 1,400, their sales per year. The fixed order cost, F, is 23, and the carrying cost, CC, is $1.85. So I've got my inputs, I put that into the formula, and I calculate the economic order quantity. So how much is the economic order quantity for this product? 196.57 units. We can't order 0.57 of a unit, can we? So what would we, 186 or 187, that's the exact result. So they would order 186 or 187 units, which is close enough for them to minimize the total costs associated with their inventory. So this question, next question, we've already looked at week 8. So there's another question here from week 8. You've got a portfolio of shares and your portfolio is invested as follows: 20% in company Alpha, 30% in company Beta, and 50% in company Gamma. These are the weights. You don't even have to calculate them. So the weight for this one is 20% or 0.2. The weight for Beta is 0.3. And the weight for Gamma is 0.5. So all the weights are given. We don't even have to calculate them. In the table underneath, there's 3 possible states for the economy. And then for each of the companies that we've invested in our portfolio, the expected return in that state of the economy. So in Boom, Alpha is expected to return 35%, Beta 10%, Gamma 18%. And we're told calculate the expected return from the portfolio. I find it's really helpful if you have a portfolio and you have information like this, where you have the company name to add the weight with the company name. So if I was trying to answer this question in a test or an exam, you could use this table as a starting point. I've actually recreated the table underneath. And I've added the weight, so I don't have to keep looking up to the top of the page. The weight of alpha is 20%. The weight of beta was 30%. 50% of our money is invested in gamma. So I've added the weights. And then I've got the 3 states of the economy. If the economy is booming, there's a 10% probability that the economy is booming. 20% of our money is invested in alpha, and the expected return from alpha is 35%. So the weight, 20% is the weight multiplied by the expected return of 35%. Plus 30% of our money is invested in beta. So 30% multiplied by the expected return of 10%. So this multiplied by this. 30% multiplied by 10%. Plus 50% of our money is invested in gamma multiplied by 18%. 50% multiplied by 18%. So I've got the weight multiplied by the expected return plus the weight multiplied by the expected return plus the weight multiplied by the expected return. And all of that is multiplied by the probability of that state occurring. There's a 10% probability that the economy will be in boom. So all of those are multiplied by the probability of the economy booming. So 0.19 multiplied by the 10% probability gives me this expected return if the economy is in boom. And then I have to repeat the process if the economy is in the normal state. In the normal state, 20% of my money is invested in alpha, and I expect a return of 12%. So 20% multiplied by 12%. 30% of my money is in beta. I expect a return of 5%. So 30% multiplied by 5%. 50% of my money is in gamma. I expect a return of 12%. I add them all together, and then I multiply by the probability of the economy being normal. There's a 60% probability that the economy will be in the normal state. So 0.099 multiplied by the 60% probability gives me the expected return in the normal state. Plus, there's a 30% probability that the economy is going to be in a poor state. In a poor state, I've got 20% of my money in alpha. Alpha is expected to have a return of minus 20%. So 20% multiplied by minus 20%. Plus 30% of my money in beta multiplied by minus 3%. 30% multiplied by minus 3%. Plus 50% of my money in gamma multiplied by 8%. 50% multiplied by 8%. And then I multiply all of that by the probability that the economy will be in that poor state, 30%. 30% probability multiplied by 30%. So the expected return is minus 0.0027 in that state. And then I need to add them all together because the probabilities add up to 100%. I need to add up all of these expected returns. So 0.019 plus 0.0594 minus 0.0027 gives me the expected return from the portfolio. So when you're doing calculations that relate to a portfolio of assets, it's easy for it to get messy and confusing. Using some sort of table format is usually good so that you can structure your calculations. You're less likely to get confused. I'm less likely to get confused marking it. So it's just good to show some sort of table. It doesn't have to look exactly like this, but some sort of table format where you can clearly do the calculations and you're not confused, you don't add the wrong things together. Are there any questions about the calculations for this one? So that was for a portfolio, the expected return from a portfolio of assets. So we've looked at the expected return from a single asset, that was in the first question, and the expected return from a portfolio of assets. If there's a portfolio of assets, these weights, how much money you have invested in each asset, which was up here, that's really, really important if it's a portfolio. Don't forget to include that in the calculations. Question 4 is based on week 6. Week 6, we were looking at the investing decision, what assets to invest in and how we could best make the investing decision. So we were focusing on the investment decision in week 6, what assets to invest in. The main goal of an organization should be to make the shareholders wealthier, because we were focusing on organizations that exist to make profit that are owned by shareholders. So their primary goal for financial management should be maximize the wealth of the shareholders, which they can do by maximizing the company's share price. Whatever assets we decide to invest in, they should help us to achieve the goal of maximizing the company's share price, making the shareholders wealthier. We looked at different methods, but the most important method, the most reliable method that we looked at was the net present value. The net present value is calculated as the difference between the present value of the future cash flows from the asset or project less the cost of the asset, which I think is explained in the formula here on the bottom right. The net present value is equal to the sum of the present values of all the cash flows from the asset minus CF0 is your cost, your initial cash flow at time 0, your cost. So that's the formula that we use to calculate net present value. The decision rule with net present value, if the net present value is greater than 0, we invest. It's a good investment if the net present value is greater than 0. The investment can add value to the firm and it will increase the wealth of the shareholders if the net present value is greater than 0. If the net present value is negative, reject. Not a good investment. It's going to reduce the wealth of the shareholders if you invest in an asset with a negative NPV. We like net present value because it's based on cash flow. It includes all the cash flows. Every cash flow is included. It considers the time value of money. And we can adjust for risk by adjusting the discount rate, the R that we use in the calculation. An NPV will allow us to rank mutually exclusive projects. What does mutually exclusive mean? We can only choose one. For whatever reason, it could be because we only have limited money, whatever the reason is, we can only choose one asset. We have to choose one. We say they're mutually exclusive. We also looked at the payback period. Is the payback period a good method to use to make investment decisions? Overall, no, it's too simplistic. It ignores the time value of money. It is based on cash flow, but it ignores the time value of money. And it encourages managers to have more of a short-term focus and to focus on how quickly they can get their money back, instead of focusing on how much wealth they can generate for the shareholders. So the payback period measures how long it takes to get your money back from the project. How long will it take to recover the cost? If you spend $100,000 on an asset, how many years will it take you to get your $100,000 back? The quicker, the better with payback period, but it's not a good method. You should not rely on this one on its own because it doesn't consider the time value of money. We talked about this one. This one's also not a good method. The average accounting return is not a good method. It ignores the time value of money. And my biggest issue with it is it's based on profit, accounting profit, not cash flow. And profit can be manipulated. Profit can be made to appear higher or lower depending on the situation. So in practice, we very rarely use the average accounting return because of those limitations of using that method. In practice, financial managers will typically use NPV and IRR, the internal rate of return. And in a lot of situations, NPV and IRR will lead the manager to make a consistent decision. If there's any conflict between NPV and IRR, we rely on NPV. That one should always prevail in our investment decision-making. So the internal rate of return is the one that's very similar to NPV. It's the discount rate, the R, that will give us an NPV of 0. But the decision rule is not explicit like NPV. The decision rule is if the internal rate of return is greater than the firm's minimum required return, then we should invest in the asset. NPV is very clear. If it's positive, invest because it can generate wealth. If it's negative, do not invest. It's not going to generate wealth. This one, not so clear because the firm needs to have determined a minimum rate of return that's acceptable for their investments. I don't know if you remember me talking about internal rate of return, but it's very easy to calculate in Excel, but you don't have access to use Excel in the final exam. So I'm not going to expect you to calculate internal rate of return because it's just time consuming. Just understand what it is, but you don't need to do IRR calculations in the exam. But I could very easily ask you to calculate NPV or payback period. Those calculations we covered and we practiced, and they're a bit more straightforward. So we've talked about that. We know that NPV will always prevail. We should always rely on that method. And that was it from there. So if we just go back to that question. So in this question, we've got 2 investment proposals. They're mutually exclusive. So they can only choose one. They've identified 2. I can see they have the same cost, but they can only choose one of the 2. The first thing we have to do is explain what is meant by mutually exclusive. And that can be as simple as saying they can't invest in both, they can only choose one. They have to make a choice between them. The second thing we have to do is calculate the NPV for both projects. There's a formula on the formula sheet to calculate NPV. I'm actually going to go back and grab it from the PowerPoints. The formula to calculate NPV. Oh, it's all separate. Can I do that? No. This is the formula that we're going to use to calculate NPV. The sum of the present value of all the cash flows minus the initial cost or the cash flow at time zero. So this is the formula that I'm using to calculate NPV. So the present value of a cash flow So the present value of a cash flow is equal to the cash flow divided by 1 plus R to the power of T. And however many cash flows there are, we need to do this present value calculation over and over for each cash flow. So in this particular question, there are 4 future cash flows. There's a cash flow in year 1, year 2, year 3, and year 4. So I need to use that present value formula 4 times, once for each cash flow, and then subtract that initial cost minus the 600,000. So this is the cash flow at time 1. So I prefer to do it this way. So the cash flow at time 1 is 70,000 divided by 1 plus R. We're told the required rate of return is 14%. That's my R. Divided by 1 plus R to the power of 1 because that's year 1. And then the cash flow in year 2 divided by 1 plus R to the power of 2. The cash flow in year 3 divided by 1 plus R to the power of 3. The cash flow in year 4 divided by 1 plus R to the power of 4, and then subtract that initial cost at the end. So I get a net present value of minus 141,445. Is that a good investment? Pretty bad investment. It's got a large negative NPV. Just looking at that, don't invest in that one. So we repeat the process with the other investment. So the cash flow each year divided by 1 plus R to the power of T, just using that formula again. And we add them all together and subtract the cost. So the cash flow in year 1 divided by 1 plus R to the power of 1. The cash flow in year 2 divided by 1 plus R to the power of 2. The cash flow in year 3 was 200,000 divided by 1 plus R to the power of 3. And then we had 80,000 in year 4 divided by 1 plus R to the power of 4. And subtract the cost. Don't forget to subtract the cost at the end. So the net present value is minus 88,307. Good investment? No. What should they do? Correct. Don't invest in either of them. You're right. They're both bad. In this case, don't say, oh, choose the one with the smaller negative NPV. Don't say that. No, they won't do that. They won't invest in either of them. They'll reject them both. In that case, I would say to the managers that brought those proposals forward, what were you doing here? Go back and get me some new investment opportunities. These are no good. You would keep looking for investment opportunities. You wouldn't invest in a negative NPV. So we calculated the NPV. We also have to calculate the payback periods, and we've already answered part D. We wouldn't invest in either of them. So the payback period for Project New South Wales, in year 1, we get 70,000. In year 2, we get another 70,000. In year 3, we get another 70,000. So that's $210,000 across the first 3 years, $210,000. In the fourth year, we still need $390,000. The cost is $500 and we've received $210,000 so far. So the cost minus all these cash flows that we've received $210,000 so far. So that's a total of $210,000. So $500,000 minus $210,000 is $290,000 divided by 500, which is 0.78. So 3 full years, 3 full years plus 0.78. So the payback period is 3 full years plus 0.78 of the next year. So 3.78 or 3.8 years. And for Project Victoria, it was exactly 3 years, the payback period. And the last part, don't accept either, reject both. They've both got negative NPVs. Any questions? Any questions on NPV, payback period, on those calculations there? So the next question is from the week 9 PowerPoints. We've got some information about a company. The company has 400,000 ordinary shares. They're ordinary shares on issue. The shares have a current price of $43.20 per share. The beta is 1.2. They just paid a dividend of $2.50, and the dividend is expected to grow at 5% each year into the future. The risk-free rate is 3.5%, and the expected return on the market's 10%. Ignore tax, so we don't overcomplicate things. We need to calculate the cost of equity using the dividend growth model and the cost of equity using the CAPM equation. So let's have a look. We'll go to the PowerPoints for week 9 and have a look at calculating the cost of equity. Week 9 was where we were talking about measuring the weighted average cost of capital in week 9. And as part of measuring the weighted average cost of capital, we looked at measuring the cost of equity. We talked about how a company could measure its cost of equity for ordinary shares. So we talked about how, from the investor's point of view, the investor considers it a rate of return or a required rate of return. When we talk about the required rate of return, that's from the investor's point of view. From the company's point of view, it's a cost. And we started off looking at how we could measure the cost of equity, the cost of ordinary shares for a company. And we looked at those two methods, the dividend growth model and the CAPM equation. We looked at both of those for measuring the cost of equity. The dividend growth model we first looked at in week 5, but we looked at it to calculate the price, to estimate the price or the value. We used it in this format in week 5. If we rearrange this equation, we can focus on the required rate of return for the shareholder, which is the cost for the company. The required rate of return for the shareholder is equal to D1. What's D1? The next dividend to be paid. The dividend to be paid at time 1. The next dividend to be paid divided by P0, that's the price now, plus G. What's G? The constant growth rate in the dividends. Or that's equivalent to D0. What's D0? Dividend just paid multiplied by 1 plus G all over P0 plus G. So if we're using the dividend growth model, we would use either of these variations depending on whether we have D0 or D1. The other approach is using the CAPM equation. The required rate of return for the shareholder, RE, is equal to the risk-free rate plus beta multiplied by the expected return on the market less the risk-free rate. And the expected return on the market less the risk-free rate is referred to as the market risk premium. Can we always use both of those methods to measure the cost of equity? Can I always use this approach? Yes. That's the problem. What if the company is not paying dividends? If the company is not paying dividends, I can't use this approach to measure the cost of equity. If there are no dividends, we can't do it that way. We would have to try and do the calculation this way. The good thing about using CAPM is it includes beta. What does beta measure? Systematic risk. The systematic risk is the risk that we get rewarded for bearing because we can't diversify away from it. So if we use the CAPM equation, we're actually taking risk into consideration, which is good. This is a good approach if we can use it. So let's go back. We've looked at those two ways that we can measure the cost of equity. So if we use the dividend growth model, using the dividend growth model, there are two options, D0 or D1. If I go back up, they said they just paid a dividend. So we've got D0. They just paid a dividend. We've got D0. So we'll use D0 times 1 plus G, and G is 5%. We've got G. And we've got the price. The price is $43.20. That's our price. So we've got the price, we've got D0, and we've got G. We can use that dividend growth model to calculate the cost of equity. So putting it into the formula and solving for RE, the cost of equity, I get 11.08%. So D0 times 1 plus G divided by P0 plus G, 11.08%. So the other way, using the CAPM equation, we need the risk-free rate. The risk-free rate's 3.5%. We need beta. Beta is 1.2. And the expected return on the market of 10%, we need that as well. So we've got RF, we've got ERM, and we've got beta of 1.2. So we can use the CAPM equation. So using the CAPM equation, the cost of equity is 11.3%. If we were doing this in practice to try and work out the weighted average cost of capital, and we needed the cost of equity for the weighted average cost of capital, if I used both of the methods and got these results in practice, what would I then do? Yeah, average them because they're quite similar. 11.08 and 11.3, they're quite similar. So in practice, what I would be most likely to do is take an average and use an average of those two as my cost of equity, my cost of ordinary shares. Are there any questions that you guys have so far on any of the calculations that we've done? So the next question, this one's also based on week 8. Week 8 was where we talked about risk and return. And this question says, what is the expected return from your portfolio? We're not given the weights. I'm not given the weight of each asset in my portfolio.
Expected return and divided by the number of shares that are in the company.
Yeah, good. So we can calculate the weight that each company makes up in the portfolio. We've got 400 shares in Company North, and the price per share is $10. So 400 multiplied by 10 tells us how much of our money we have invested in North. And for East, we've got 1,500 shares at $1 each. Multiply them together, we've got $1,500 invested in East. And South, 650 shares multiplied by $4 per share. So we can get the total dollar amount that we have invested in each company, and we can add them all up and get the total. So that's what I started with. So I made another table, but you could always work off the table that was given there. And the first part of the table that I did was this part over here. So 400 shares in North multiplied by $10 per share equals a total value of $4,000. So 400 times $10 gives me the total value of $4,000. 1,500 times $1 gives me the total value of $1,500. 650 times $4 gives me a total value of $2,600. I add all of those together and my total portfolio value is $8,100. So then I calculate the weight. So the weight for North is equal to, I've got $4,000 invested in North out of a total $8,100. So 4,000 invested in North divided by the total 8,100. So it's about 49% of my money is invested in shares in North. I do the same for East. I've got $1,500 invested in shares in East divided by the total value of my portfolio, and I get 0.1852, or about 18.5% of my money is invested in East. And I do the same for South. I've got $2,600 invested in South. The total value of my portfolio is $8,100, so it's about 32% of my portfolio. Then I take the weight and multiply it by the expected return. I multiply it by the return from the shares in that company. So if I just go back up, for North, the expected return's 25%. So the weight multiplied by the expected return gives me 0.12345. So 0.4938 multiplied by 0.25. And then for East, the weight 0.1852 multiplied by the return of 10% is 0.01852. And for South, the weight is 0.3210 multiplied by 0.17, or 17%, is 0.05457. And then I add these together, add them all together, and I get this total. So I've got my weight multiplied by my expected return for each asset in the portfolio, add them all together. So the expected return from my portfolio is 0.19654, or about 19.65% overall from the whole portfolio. So in that case, we weren't given the weights. The starting point was actually saying, well, we have to calculate the weight of each asset in the portfolio. We calculated the weights, and then we multiply the weight by the expected return. Are there any questions about any of the calculations in that one? So that's another calculation of expected return from a portfolio. In the previous question, we were given the weights. But in this question, we weren't given the weights. We had to calculate the weights. If there's no questions, guys, it's 4:30. So why don't we pause? Let's pause there and we'll take a break. So this question here is actually a combination of a calculation from week 9 that related to the cost of equity and a calculation from week 6. The company is evaluating a new investment opportunity. We looked at the investment decision in week 6. So this investment decision is from week 6. They're considering investing in new machines for the factory, and they'll finance the purchase entirely with equity. The investment in the machines will cost $500,000 today, and it will generate $120,000 per year in year 1 and year 2 and year 3, and $200,000 per year in year 4 and year 5 and year 6. So there are 6 cash flows from this investment. The company's provided us with some estimates. They've given us the risk-free rate. It's 6%. The beta is 1.05, and the expected return on the market portfolio is 16%. We need to calculate the cost of equity using the CAPM equation. Calculate the cost of equity using the CAPM equation. So to do that, we need the risk-free rate for CAPM. We need beta for CAPM. And we need the expected return on the market portfolio for CAPM. And with all of those inputs, we can calculate the cost of equity. So the cost of equity is 16.5% for the company. And they intend to finance the whole project with equity. Part B says, should the company proceed with the investment opportunity? What do we need to do so that we can make a firm and defendable decision about whether or not they should invest? What tool do we normally use to make investment decisions? NPV. So we need to calculate the NPV. To make an appropriate recommendation about whether they should invest or not, we need to calculate the NPV. We've got R. R is 16.5%. We've got our R to calculate NPV. We've got the cost. The cost is $500,000. And there are 6 cash flows. 120,000 in year 1, year 2, year 3, and 200,000 in year 4, year 5, year 6. So we've got the cost, all the cash flows, and we've got R, the discount rate, to calculate NPV. So for part B, we need to calculate NPV, and we're going to use our cost of equity as the discount rate. So the cash flow in year 1 is 120,000. We're going to calculate the present value of the cash flow in year 1. So the cash flow divided by 1 plus R to the power of 1, because it's year 1, plus the cash flow in year 2 is 120,000 divided by 1 plus R to the power of 2, plus the cash flow in year 3 divided by 1 plus R to the power of 3. And then we've got 200,000 in years 4, 5, and 6. So it's the cash flow divided by 1 plus R to the power of T. And then we subtract the cost. The investment was going to cost $500,000 today. So the NPV is $49,081. It's positive. So we should invest because the project or the investment has a positive NPV. It can generate wealth at that cost of equity for the company. Any questions about that one with the cost of equity or proceeding with the investment? If we're making investment decisions, remember NPV is our favorite tool to use for investment decisions. So let's go back to the multiple choice questions and we'll just go through those as well. And I'll put the answers up on Canvas for you as well when we're finished. So the first multiple choice question was actually from week 1 of the course. The potential conflict of interest between a company's owners. What are the owners called? Shareholders and the managers. is referred to as which type of problem? It's called the agency problem. The agency problem describes the conflict of interest between shareholders and managers. It's the potential for managers to make selfish decisions that are not in the best interests of the shareholders. Question 2 was from week 11, the topic we did in week 11 on short-term financial planning and managing working capital. Net working capital, actually this is also from week 7. We talked about this in week 7 as well. Investing in net working capital for a project. Is it a sunk cost? No. What's a sunk cost? A past cost. And remember, they're not relevant for investment decision making. They're not a future cost. They're not relevant when we're making investment decisions. What's an opportunity cost? The opportunity that we miss out on because we choose to invest in A instead of B is referred to as the opportunity cost. The correct answer is to say that if we invest in net working capital with a project, we normally recover the amount at the end of the project. We recoup or recover the investment in net working capital. So it's a negative cash flow at the beginning of the project and a positive cash flow at the end of the project because we recover the money. Question 3 is from week 7, a pro forma financial statement. Pro forma financial statement is like a budgeted financial statement. That's another way that you could describe them. A budgeted financial statement. It's about forecasting or projecting the future, a pro forma financial statement. It doesn't express everything as a percentage. That's actually referring to common size statements. And it's not about comparing the actual results to the budget. That's what we call variance analysis. It's just about projecting the future results for the company. Is that rain that we can hear? Go away while we're in here. So question 4 is about risk. Question 4 says the higher the standard deviation, the expected rate of return and the risk. A higher standard deviation means higher risk. With higher risk comes higher return. So they're both higher. Higher return, higher risk with a higher standard deviation. Question 5 was from week 8, where we looked at risk and return. Which of the following is an example of systematic risk? Remember, systematic is the market-wide risk. Which one's an example of market-wide risk? Resignation of the CFO, that's very company specific. So it's not that one. That's unsystematic. Inflation is market-wide. Inflation will affect most companies in the market, so that's why it's the answer. An increase in overseas sales for a multinational company, that's also something that's very company specific. And higher profits than forecasted is also company specific. So the only one that's a market-wide factor is the inflation. That's our systematic risk factor. Wow, it's pretty crazy. I hope it's quick passing over. Question 6 is on capital structure. And it says, what's the optimal capital structure for a company? Remember, there's no silver bullet. There's no magic capital structure that would work perfectly for all companies. So B and C are silly answers because there's no ideal use of debt and equity that would fit for every company. And it's got nothing to do with earnings per share equaling $1. It's the debt to equity ratio that can give them the lowest possible cost of capital. The lowest possible cost of capital would be a good outcome for the company to enable them to maximize the wealth of the shareholders. So whatever ratio that might be, that can minimize their weighted average cost of capital. That's the best capital structure. Question 7 was from the PowerPoints in week 10, and it was about underwriting. Which type of underwriting is where the underwriters have to buy all of the unsold securities? The type of underwriting where they buy the unsold securities, standby underwriting, which is the type most common in Australia, standby underwriting. The underwriters have to buy any securities that they're not able to sell to the market. Remember, we talked about underpricing and how they often set a lower price. By setting a lower price and making sure they sell all the securities, they don't have to buy unsold shares at the end of the process. So underpricing can actually benefit the underwriter as well. So question 8, the time between paying for inventory and receiving cash from the customer, the time period is referred to as the cash cycle. The cash cycle. What was the other cycle that we looked at in week 11? Operating cycle. What does that measure the time between? Yep. So the operating cycle measures the time between purchasing inventory from the supplier and getting the cash from the customer. So we just have to be careful. The cash cycle is the time between paying the supplier and receiving cash. The operating cycle is the time between when we purchase the inventory to when we get the cash from the customer. Question 9 says Don's a local builder. He keeps an extra $500,000 of cash for any emergency that might arise. Which motive is that referring to for holding cash? It's the precautionary. He's trying to be safe and not run out of cash, so he keeps an extra $5,000 in case of an emergency. And question 10 was about preference shares. Which statement is true about preference shares? The preference share is a form of ownership in a company. It is. There are two types of equity ownership in a company, ordinary shares and preference shares. So it is a form of ownership. The preference share has preference or priority over ordinary shares for payment of dividends. That's also true. Preference shares always get paid before the ordinary shareholders, always. And holders of preference shares usually have no voting rights. That's also true. Normally, ordinary shareholders normally get voting rights. Preference shareholders normally don't get any voting rights. So all of those statements are actually true about preference shares. So the answer is D. So you can see with multiple choice, I mean, I just made some random multiple choice questions to put in there just because I wanted you to get a bit of practice. There are 10 multiple choice in your exam, and you don't need to have memorized all the theory in the course to be able to answer some of these multiple choice. You know, some of them, looking at it, you can see that there's a bit of common sense. This one you would need to know. You would need to know the theory to know the answer to question 8. But some of them you can sort of use logic. Like this one, answers B, C, and D were all quite silly. There is no recommended capital structure, so the only answer could be A. So for some of them, you would be able to work out the answer even if you hadn't studied that topic very carefully. So make sure that you practice a lot before the final exam. Make sure that you can do those calculations in the practice questions here. There are practice questions that are still up on Canvas for test 1 and test 2 that we did earlier. There's workshop questions and self-study questions. There's heaps of possibilities for you to use for practice. The more you practice, the quicker you'll be able to do the questions in the exam. So by practicing, you're actually going to get faster at using the formulas and solving the questions. Make sure that you're familiar with the formula sheet. It will be printed as a part of your final exam. You're only allowed to take one A4 page into the exam. Make sure that you only bring one. If you bring more than one, the supervisors have been instructed you're only allowed one. They'll take it away and leave you with one. Yep. I thought you did. So on the timetable, you can see the time, but not a location. Yeah, I thought I could see a location at Callahan. So on the day, what do they expect you to do? So do you go to... Let me see if I can find an answer to that question and post the information on Canvas just so that you're clear, because you really need to know where Callahan's massive. You need to know where you're going. You know, there's public transport that drops off all around the campus and car parks everywhere. So I'll try to find out a location so I can post it up on Canvas. Just make sure that you bring a calculator. They won't let you take a phone in. So the supervisors will be making sure that you leave all your bags. You can only take your 1 page, your writing materials and your calculator into the exam. Just make sure that you have what you need on the day. Are there any questions that you guys have that you wanted to ask me? Anything about the practice? Any general questions? What if you think of a question before the exam next week? What should you do? Yeah, send me an email, send me a message through Canvas. If you think of a question, if you're doing a practice question and you can't understand the answer, send me an email or a message so that it's efficient, you don't waste time, and I can help you with your study so you can keep moving on through the materials. So just contact me if you need any help when you're studying. Otherwise, guys, I don't have anything else to go through with you this week. I'll post those answers up on Canvas. We're marking your assignments. We started marking yesterday your assignments, and we're all aware that your exam's approaching, but the reality is with almost 100 assignments, it's not going to be a quick process. We're working as quickly as we can, but there's no guarantee that we can have your assignment marks out before the exam. We're trying, but we're not sure that we can get that done in time. As soon as your assignments are marked, I'll be just checking through the marking and publishing your results in Canvas and posting up an announcement to let you know. So if you have any questions, you can come and ask me now, or you can send me an email if there's anything that you think of. I'll put these solutions up on Canvas. Good luck with your studies. I hope you guys can study really hard between now and the exam, get a good mark in the final exam, and then enjoy a bit of a break after the exams before next trimester. So study hard and take care. I'll see you around.